Okay, we're going to continue a little bit further on Chapter 4. Let's see what we've got here. We're going to understand, hopefully, the computation and allocation of consolidated net income when we have this non-controlling interest. So let's see what we've got here. Subsidiaries net income, including the excess acquisition date fair value amortizations. We're familiar with setting that up. Must be allocated to its owners. So its share of these acquisition date fair value amortizations will be allocated to the non-controlling interest. In fact, it'll be allocated to the parent and the non-controlling interest in their pro rata equity position. Let's see, you could pause and read this slide and we'll move forward to get to some examples. And here we go. Here's an example. We're still doing that same 90-10% example, I believe, that we started in the last session with parent company buying strong, and it was a 90-10 situation, 90% controlling interest, 10% non-controlling. So let's see what happens on the income statement. Look here, the total revenues of the subsidiary is 280. The total expenses of the subsidiary is 200, giving this subsidiary strong, that's the name of the subsidiary, is net income of $80,000. The excess acquisition amortization causes the net income to go down in this particular example. It doesn't have to be, it's just an example. And it goes to $50,000. Now, 10% of that number, the number as adjusted for the excess amortization, is $5,000. That will be, when we get to the consolidated financial statement, on the income statement, that will be shown as the non-controlling interest share of the subsidiary net income, or actually the non-controlling interest share of the consolidated net income. Because after all, the non-controlling interest doesn't own any of the parent, it only owns this 10% of the subsidiary. So when we get to the consolidated net income statement, only $5,000 will show as the non-controlling interest share of the total consolidated net income. All right, what we want to see here is that there are 4 presentations on a consolidated financial statement where we're going to concentrate on showing something to the reader about the non-controlling interest. And let's see what they are. Notice that the first part of this tells us that the consolidation process remains substantially unchanged from when we had 100% ownership, because we're still doing 100% of assets and liabilities. We're just allocating of the assets and income statement. We're allocating off the balance sheet and the income statement the amount to the non-controlling interest. And the example in this presentation is at some 90%, 10%. It could be any other percentages as well. So the issues that we're going to show up about the non-controlling interest is we will show the opening subsidiary, quote, equity position of the consolidated statement. That'll be the beginning of the current year. We'll show the subsidiary's current year net income that belongs to the non-controlling interest. We just spoke about that. We'll show the amount of dividends that belong to the non-controlling interest shareholders, and we'll show the, quote, equity of the consolidated financial statement that belongs to the non-controlling interest at the end of the year. Those are the things that will show up. Again, these are things that are fun to talk about, wonderfully presented here in this PowerPoint, but mean a whole lot more when you actually see it. So let's do an example. King Company acquired, we have a new example now. Now we got new numbers, new example, new facts. King Company acquires 80% of Pawn, so we're going to have a 20% non-controlling interest. The total number of shares is 100,000. All right, and the purchase price is $975 for a total of $780,000 cash. You could do the math to prove it. 80,000 shares times 9.75 is $780,000 cash. The shares are trading at the same value, so now we know that the price paid for 80% is without a control premium. By the way, in the part 1 video, when we said that the control premium represents goodwill, that's always the case. Control premium will always be allocated to goodwill. Okay, so there is no control premium here. There may still be goodwill, depending on what is the net identifiable assets, or shall we say identifiable net asset value of the underlying assets and liabilities of Pawn. But let's move forward before we find that out. So the 100% value of Pawn is $975 per share, 100,000 shares at date of acquisition, which we now know is January 1, 2014. $975,000. That's the value under the acquisition date method for Pawn on this acquisition date. Great. So far, so good. Here is the facts presented to us showing the difference between the $975 value, the book value, and the explanation of the difference between the fair value and the book value in terms of identifiable net assets. We've got trademarks, we've got patented technology, we've got equipment, we've got some long-term liabilities, and so therefore we've got a difference of between the 235. Now this is interesting to look at and see how this works when we have long-term liabilities. We last left discussing long-term liabilities or liabilities in general as being different than the book value, and we went through on the board in class how you determine whether it's going to increase or decrease interest expense. Look how this is presented. This is presented as what looks like that long-term liabilities are valued at more than the books because you see $40,000 there with no brackets, but that's not the case. The no brackets simply means this is really like a debit charge to the liabilities, and hence the liabilities are actually lower than the book value on the books of the subsidiary. The fair value of the liabilities in this case, with 8 years to maturity, is $40,000 lower. Let's prove that. Look at the math. The total fair value of the subsidiary is $975. The book value is $740. How do we explain the difference? There are $60,000 of trademarks. So of the $235,000, $60,000 belongs to trademarks. 120 belongs to technology. So of the 235, we've explained 180, but the equipment actually turns out to be less than the book value. So now we're going to reduce the 180 that we've accounted for. We're going to reduce that by 10. So now we've accounted for 170 of the $235,000. So we're explaining the difference between the fair value and the book value, and we've come out to a net $170,000 that we've been able to explain from the asset side of the balance sheet of the subsidiary, comparing its, again, fair value of its assets versus the fair value that we paid above book value. But then the $40,000, if the liabilities were actually worth more in fair value terms than the book, the $40,000 would be a subtraction from where we're holding at 170. It would be really a subtraction because that's what liabilities do. They subtract from the fair value, and that would make it would put us at 130. But in actual fact, what's happening, you can do the math, what's actually happening is that we are now saying that the liabilities are not taking away from the net assets calculation, they're actually adding. So it must be that the liabilities are lower than the book value. The fair value of the liabilities must be lower than the book value. And so therefore we add that because the identifiable net assets is now at 210, which is why the goodwill, the residual method of the goodwill, is calculated at $25,000. Do the math and you'll see what I'm talking about, and the proof is even further in the pudding here when you see that the long-term liabilities, which has an 8-year to maturity, creates excess amortization. And the way that works, again from the last class, is that if we're saying that the liabilities are valued less than the book value, it means that there will be more interest expense, and that's exactly how we're going to treat the annual amortization over the 8 years, increasing the interest expense. Go back to your notes if you need to follow that. Take a look at the textbook. Hopefully it's in there, and you'll see what I mean. So the upshot here is that we now know that the goodwill for the total 100% of the company is $25,000, and we now know how much to amortize the excess between the technology and the equipment and the liabilities. Notice that the trademark has an indefinite life, so there is no amortization there. How does the goodwill break down between the controlling and the non-controlling interest? Here, simply at this point in time, since there's no control premium, it's a pro rata proportionate share of the $25,000. 80% belongs to the controlling interest and 20% to the non-controlling interest. Pretty simple. And let's see what this says to complete this formation. I'll tell you what, let's hold there. There's a lot to absorb. Take a few minutes and go over this. Make sure you understand what we've done so far, and then we'll reconvene once again.